Buenos días. Pero creo que ya se escucha. Sí. Tenemos que usar el micrófono, tengo entendido por la conexión. Buenos días. Le damos la bienvenida nuevamente a este evento. Es el segundo y el ¿qué está pasando? Ya. Quizás hoy día sea la parte más interesante.
Que nos regale
del
el ID de
curso,
la
porque ayer se plantearon cuáles son los supuestos de la teoría que avala la inflación, ¿cómo se llama? El inflation, en inglés. No quería hacer eso. Hoy día quizás es la parte más interesante, porque vamos a ver desde la perspectiva heterodoxa las críticas y las posibilidades. Entonces hoy día, como buena escuela plural que somos, vamos a tener la otra parte de la mesa. Thanks again for being here, Jan, and we hope to get the second part of the story, which can be much more interesting. And también quiero agradecer la presencia del doctor Roberto Valencia, es uno de nuestros jóvenes profesores. Él se especializa en economía monetaria, creo que es industrial, es profesor de tiempo completo de la Facultad de Economía y miembro del Sistema Nacional de Investigadores. Creo que es ampliamente conocido por toda la facultad. Gracias por estar aquí. Un poco la mecánica va a ser la misma que ayer. Le damos el micrófono al doctor Toporowski, él va a hacer su exposición. Vayan anotando sus preguntas. También le damos la bienvenida a la gente que está en Zoom. We welcome the people that are in touch through Zoom. Please, if you have any questions, send them to the inbox and we shall put them forward. ¿Ok? Estando las cosas claras, le damos la bienvenida. Perdóname, sí. Por favor, Roberto.
Hola, solamente para recordarles que para fines de su constancia, los que están aquí de manera presencial, tienen que registrar su asistencia. Entonces, si algunos no lo han hecho, al final de la sesión van a estar aquí afuera los compañeros para que puedan escanear el QR y ahí registrar su asistencia.
Muchas gracias, se me había olvidado esa parte. Ok. I won't say the floor is you, but the mic is you.
Okay.
Yeah.
Thank you very much. Yes, before I start, I would like to just express my thanks once more to Professor Naomi Levy for her kind invitation, to Professor Roberto Valencia for his kind introduction and assistance with organizing these lectures. Today I'm going to give the second of my lectures on inflation targeting. Yesterday, I discussed the rationale for the for inflation targeting, and I said that this was rooted in the ideas of the monetary business cycle. Today, I will discuss how Keynes and Kalecki criticized this monetary business cycle. Keynes perhaps in a more complex and contradictory way. I think Kalecki in a more direct way. My talk, I will just give list to you the main topics which I will cover, so that as I'm speaking, you will know where I am. I would start off with no, we go back to the previous slide.
Sorry, what I did.
Yeah.
Excuse me.
Okay.
Perdón, sorry. Miren, ahí me siento desocupado a estas alturas ya, por favor, que se ocupen todos y que si se pueden poner aquí para que no nos vengan a regañar y a correr de aquí. ¿Ok? Pásate a Alberto Paredes. Sorry.
Yeah. I will talk about first of all Mr. Keynes and the neoclassicals, because Keynes had a very specific idea of what he meant by the neoclassicals. Keynes himself was a neoclassical at one time. He then abandoned the monetary business cycle. This was the major shift between the treatise on money and the general theory. This really, after this, his work becomes more fragmented. Kalecki, I think, worked more systematically on undermining the monetary business cycle. First of all, in a section of his original paper on the business cycle, a section on the money market in the business cycle, and then later on, after he became more aware of the discussions around the monetary business cycle, Kalecki proceeded, first of all, to criticize the analysis of the short-term rate of interest, and then the analysis of the long-term rate of interest. That's important because it then undermines, to some extent, Kalecki's criticism. And then I will say a few words by way of conclusion. Okay, let's Keynes, or Mr. Keynes and the neoclassicals. Keynes, in his general theory, he used the term neoclassical, and it's very interesting that he used this term, and he explained, when he explained what he meant by it, it's not what most of us here in this room consider to be neoclassical, in other words, marginalist and so on. Those were the theories that Keynes called the classicals. The neoclassicals were different, and in his general theory, Keynes himself said that he had been a neoclassical at one time, and the neoclassical phase in Keynes, it was really around the time of the treatise on money. The treatise on money, which was unlike the general theory, it's not put forward in equilibrium terms, but the treatise on money is put forward in terms of being a business cycle theory with a particular, with an emphasis on the analysis of money and monetary aggregates. This is why he refers to it as, this is why it's called the Treatise on Money. In this treatise, Keynes emphasized the importance of the long-term or the bond rate of interest, which he believed, he argued, was governed by the short-term rate of interest that is fixed by the government. That's fixed by the central bank. The central bank, when it sets its policy rate and it makes that policy rate effective in the banking markets, in the interbank markets, in effect also influences the long-term rate of interest or the rate of interest or the yield on bonds. This is of particular importance because the bond rate of interest or the yield on bonds is determined not in the market where, for loanable funds, where people with savings meet people who need money or firms that need money for investment. Keynes rejected this kind of thinking. Keynes argued that this crucial rate of interest or the bond rate of interest at which firms could finance themselves in the bond market, this was not determined in a market between entrepreneurs who needed savings for the purposes of investment and savers who needed to find somewhere to place their savings, but it's governed in other words, it's not in a primary market for the issuing of new bonds, but it's determined in the secondary market where bonds that have already been issued circulate, where financial investors buy and sell bonds. But he nevertheless argued that the central bank can control the long-term rate of interest through its operations to fix the short-term rate of interest and then through its open market operations, buying and selling bonds. In his analysis of the money supply, Keynes departed from very simple monetarist ideas because he argued that bank credit fluctuates with unstable velocity. Keynes distinguished between two types of money. One is the notes and coins, which is the basis of currency, and then bank deposits or credit, which is also used as means of payment, it's used as means of payment among firms, but it fluctuates with unstable velocity, essentially because of it's bank credit that is used as means of payment in the financial system. In other words, it's bank credit that fluctuates with unstable velocity. So, for example, if a firm issues a bond or a share or a stock of some kind, this is usually paid for not with banknotes or coins, but it's paid for by a transfer from a bank deposit. So this was his analysis of the money supply in the treatise on money. The business cycle is characterized by differences between aggregate saving and aggregate investment. In other words, saving is not equal to investment. The difference between them is made up by bank credit or repayments of bank credit. And then Keynes introduced a rather interesting empirical observation that he called Gibson's paradox, and named after Gibson, an English statistician who studied economic aggregates and economic data on the rate of interest in the 19th century, where he showed that the rate of interest, the rate of investment, the level of investment in the economy, and the amount of saving in the economy, they all move together. They are all pro-cyclical variables. This is something that Wicksell had been aware of. Wicksell mentions this in Interest and Prices, but he associates it with the work of the British economist Thomas Tooke in the 1840s and 1850s. Thomas Tooke, whose work incidentally also influenced Marx. Tooke had noted this fact that interest, investment and saving and economic activity all move up and down with the business cycle. And why is this a paradox? Well, it's paradoxical because according to the neoclassical theory, what is commonly known as the neoclassical theory, if the rate of interest rises, then the level of investment is supposed to fall. If the why does this not happen? And it's this paradox that lies really at the background of Wicksell's Wicksell's business cycle theory, because his business cycle theory based around the difference between the money rate of interest and the natural rate of interest was an attempt to explain this paradox. Other kinds of explanations are, for example, the notion that it's not the rate of interest that is important for investment, but it's the real rate of interest. So this was put forward by Irving Fisher, and it's the one that's commonly accepted today. But Gibson's paradox is important because it starts to undermine the monetary business cycle. And Keynes did this with his in his general theory. In that, I have to say that I'm giving a very partial view of Keynes's treatise on money. I'm looking at the part which deals with the monetary business cycle rather than his fundamental equations and so on, which he rejected later anyway. With the general theory, in the course of writing this, Keynes started making drafts of this, and he would send these drafts to his two fellow students of Marshall, Ralph Hawtrey and Dennis Robertson, both of them monetary economists, Hawtrey in particular, a pioneer of the monetary business cycle. But at some point, you can see the correspondence between them. Keynes broke off the discussion. All of them were talking about the monetary business cycle, but they were defining it in different ways. And Keynes realized something fundamentally different. It came to a different conclusion from them, and that is, and this is the starting point of a different kind of analysis, be that saving has to equal investment. When I say saving, I mean saving that is different from savings in general. Savings is a stock, the total amount of savings in the economy. Saving is a flow, it's the amount of income that is not spent on consumption. And if you look at, if you work through the national income identity between income and expenditure, it's very, you quickly come to the conclusion that saving always has to be equal to investment. And in his general theory, Keynes put forward a different view, came to a different conclusion from the monetary business cycle. He came to a conclusion that in the monetary business cycle, output and employment is determined by real factors. It's determined by the availability of resources, so that general equilibrium is at full employment of all resources. And if you go beyond, if there are fluctuations in output and employment, they are caused by changes in the real wage rate. Keynes rejected this in his general theory, and using Kahn's concept of the investment multiplier, he came to the conclusion that total output and employment are determined by investment. And in that, he argued that this was a short period equilibrium. Given a certain level of investment, that level of investment would tell you what the equilibrium, short period equilibrium level of output and employment was. But this was a short period equilibrium, short period in the sense that of given a certain capital stock, the flaw in this, in Keynes's analysis here, is the flaw that Kalecki identified, and that is that if investment changes, then and equilibrium output and employment change, then it doesn't all happen at the same price level. In fact, this change in investment sets off a cumulative process, a kind of Vixelian, Kalecki called it a Vixelian process in which prices change as well. So prices change, and then also the real wage rate changes. So these are complex changes over the business cycle, which Keynes put aside in his general theory. In the general theory, he argued something different. He realized that you had, he accepted that there was a business cycle. He attributed the business cycle to animal spirits or expectations and uncertainty. These were subjective factors, and he said he argued that this is why a long-term rate of interest which favored investment may not actually give rise to investment. So he ended up with a theory of investment that was partly determined by the long-term rate of interest and partly determined by expectations and uncertainty. And this is the element of Keynes which was then taken over by what were later called the fundamentalist Keynesians, fundamentalist post-Keynesians like George Shackle, who argued that this was Keynes's fundamental innovation in economics, the recognition that expectations and uncertainty are extremely volatile. So let me move on to Kalecki and Kalecki's analysis. Kalecki, as I will show, was much more systematic on this. Jim Robinson, after Keynes died, Jim Robinson always praised Kalecki as the more systematic Keynesian. I think in part because when Kalecki wrote, or when he studied, when he researched a particular topic, he did it in a much more concentrated way. Keynes, to a great extent, was writing. He wrote his general theory at weekends. He didn't sit down and systematically work his way through it, despite what many Keynesians and post-Keynesians say. Kalecki was aware of what was happening in the financial sector and in the money markets, although he was working in Poland, where the money markets were not so sophisticated as they were in London, where Keynes was working. And in 1933, Kalecki had not travelled outside Poland, but he did work in a business cycle institute, an institute for research on business cycles, where he read quite a lot of commentary and articles on what was happening in the financial markets and in the business press. So when he put forward his theory of the business cycle, at least in the Polish version in 1933, this contained at the end a couple of what Kalecki called applications or appendices, and there was one on the money market. Unfortunately, this was not translated into English until much later on, and didn't really appear until the collected works were published in the 1990s. Kalecki in this explained how the money market operated over the business cycle. So this is his version of the monetary business cycle. It starts off with the idea, with a distinction between investment decisions and current investment. Current investment is the expenditure on fixed capital investment that is currently taking place. Kalecki distinguished this from investment decisions because he argued that if you're interested in knowing what is current investment and what will happen to investment, you have to study investment decisions and how these are made and why these are made. Because if you just look at what current investment is, current investment is the outcome of previous investment decisions, and there are long lags, and these lags do affect the money market. This is fundamentally different to the tradition of Keynes from Alfred Marshall, where investment takes place instantaneously. If there's a certain level of investment in this period, if it's different in the next period, it's planned and takes place instantaneously for the next period. According to Kalecki, what happens is that when investment decisions are made, decisions to invest in particular plant and machinery, once these are made, the firms transfer deposits from what are called unattached deposits or savings to investment or financing reserve, what are called financing reserves in the translation. I have to say, and I say this, I think I don't mean any disrespect to Kalecki or any of his translators, but some of the terms used in the English translation are not very good and not very accurate in their decisions. So firms, when they make these investment decisions, they transfer money from their savings accounts which are liquid, where they can take money out, giving a certain period of notice, but they are interest-bearing accounts, to investment reserves, in other words, the current accounts that are used to pay for investment. And these payments, as these payments are made for the plant and machinery, these put the bank deposits into circulation. So the plant and machinery is ordered, it's paid for, and the bank deposit goes into circulation. And so that, and this is what happens over the business cycle. During the rising half of the cycle, the accounts of the investment reserves and money in circulation increase at the expense of unattached deposits. So there's an increase in money in current accounts, in payment accounts, and then that money is taken from savings accounts. In the second half of the cycle, during the recession, the opposite transfer. The money is transferred from the accounts, from the current accounts, from payment accounts, back to the savings accounts. So in this sense, it's a kind of liquidity preference. The firms start to accumulate more savings accounts. And this is the intriguing conclusion that the overall, the total of the accounts in the consolidated balance sheet of the banking system stays the same. If you take the banking system as being the consolidated accounts containing the saving accounts and the payment accounts, their total stays the same. It's just that the composition of that balance sheet changes. And here is an interesting observation, very typical of Kalecki, lost somewhere in his narrative, is this observation that changes in the rate of interest are determined by the mechanism of the business cycle rather than determining it. So what does this say about the monetary business cycle? It says that actually the monetary business cycle is endogenous to the actual business cycle. More than this, credit spent on investment finds its way back to the money market through profits. This is again something that comes from a separate section in the main part of the business cycle analysis, the theory of profits, that says that when the amount of money spent on investment then appears as comes back to capitalists as profits. It comes back to their accounts as profit, into their payment accounts, and from which they then move it into the savings accounts. This is why you find a comment which subsequently appears in all the versions of the business cycle theory, that essentially investment finances itself. A point which I think Kalecki Keynes would have understood, and I think Keynes did understand, actually Joan Robinson had a great deal of difficulty understanding. A lot of their correspondence is around this idea. Let me move now on to Kalecki and the short-term rate of interest. This emerges later on. It's in Kalecki's work, 1942. Kalecki is working and commenting on war finance. He's still taking forward the same fundamental ideas from this concept of the money market, but he argues that there is an inverse relationship between the short-term rate of interest and the velocity of circulation of bank deposits. Why? And here we come back to this idea that investment decisions involve an actual investment, involve transfers from savings accounts to payment accounts. What Kalecki had in mind when talking about the velocity of circulation of bank deposits, he meant the velocity of circulation of bank deposits between savings accounts and the payment accounts. Or if you like, between payment accounts and short-term savings, holdings of bills, or what you find in quite a lot in the United States, money market funds, where money market funds expand when interest rates are high, they decrease when interest rates are low. It's an interesting idea which I know Malcolm Sawyer, who will be speaking on Monday, in his article on Kalecki's monetary theory, he associates this with a theory of the demand for money by Baumol, where Baumol forward this idea that the velocity of circulation of money is inversely related to the rate of interest. I have to emphasize that the velocity of circulation that Baumol was writing about is different to the velocity of circulation that Kalecki was writing about, because Baumol's velocity of circulation is the velocity of circulation of money through the economy, and not through and not just between payment accounts and savings accounts. There's I could give a very nice example of this during the COVID episode. One of the peculiarities of the COVID, it was a tragic episode, but from the point of view of what was happening in the money markets, it's a very, very interesting episode, because you had a confirmation, essentially, of Kalecki's idea, because during the COVID period, interest rates went down virtually to zero. Households accumulated incomes very often which they couldn't spend because people couldn't go to restaurants, you couldn't travel. So hospitality and travel were, the expenditure on that was heavily reduced. And sure enough, what you had was exactly what Kalecki predicted, that at zero rates of interest, there's no reason to hold money in a savings account because you weren't going to make money on it anyway. There was a huge increase in the amount of money in payment accounts, in payment deposit accounts. And then after a while, something interesting happened that there was a decrease, quite an unusually sharp decrease in household unsecured borrowing. Now, household unsecured borrowing is essentially credit card borrowing. After a while, households just started paying off their credit card bills. Why? Because they knew, householders know, those who have credit card debt know this is the most expensive kind of debt. So this is worth, I think this, again, is something that's worth following up. I don't know how this happened in Mexico, but I suspect that certainly in the United States, in Europe, the situation is fairly similar. Okay, let me move on to the long-term rate of interest. As in Keynes, the long-term rate is the relevant rate or the reference rate for investment in fixed capital. Why is this? Well, for the obvious reason that if you're going to buy a piece of productive machinery with a lifetime of 10 years, let's say, the opportunity cost of that piece of equipment is a 10-year bond. If you can make more money with the machinery, this is the arbitrage point of view, this is I guess the Vixelian Hicksian point of view, or Tobin view, you would buy the machinery. If you can make more money in buying the bond, then you don't bother buying the machinery, you buy the bond. So it's this long-term rate that's relevant for investment in fixed capital. This is why, one of the reasons why Keynes was departed from the monetary business cycle in saying that it's the long-term rate that counts, not the short-term rate. And secondly, Keynes was aware, as Kalecki was, that of the distinction between financing and funding. Financing is the process of how firms get the money for in order to pay for investment. And Keynes and Kalecki were very aware, actually Hawtrey himself, they were very aware that for the most part, firms do this out of their own savings, out of their own liquid reserves, out of those savings accounts that Kalecki was talking about. If that is not enough, then they borrow the money from a bank. They borrow short term. Why is this? Well, because plant and machinery is not really good security for a loan. It's not plant and machinery cannot be sold at very, very quickly, in the same way that, let's say, a bond can be sold. But funding investment is really the process by which a firm, after it's bought the plant and machinery, after the plant and machinery is in operation, the firm will issue a long-term bond and use that long-term bond to replenish its savings accounts or its liquid reserves and repay bank debts. So funding is actually an important process in the corporate finance. When after Keynes' general theory came out, there was, of course, it shocked the world, shocked the economist world with its new ideas. Amongst those ideas was the idea that this long-term rate of interest is more important than the short-term rate of interest. So this kind of this criticism of the monetary business cycle, and it was followed by a rash of studies of the long-term rate of interest. By the 1930s, there were long time series of interest rates, long-term interest rates, in particular on a very peculiarly British kind of bond, or a bond that was peculiar to the United Kingdom, known as consolidated funds. The consolidated funds were a perpetual bond that had been introduced during the wars with France after the French Revolution and during the Napoleonic period. They were known for short as consols. Why were these studied? Well, these were studied because in a sense it gave you, it allowed you to look at the pure long-term rate of interest without having to worry about fluctuations in the price or the repayment date, the maturity of the bond. So these particular studies were done by Ralph Hawtrey, George Shackle, Hicks, and Kalecki. The study by Ralph Hawtrey was published in his important book, A Century of Bank Rate. These were the Marshall Lectures, which Hawtrey gave in 1938, and he devoted a large part of these Marshall Lectures to a critique of of Keynes's general theory. Quite an interesting one, because it's one that, if you look at the Keynesian literature, this is largely never mentioned. You know, Hawtrey appears in the Keynesian literature as being the villain who argued for lower wages throughout the 1930s, even when workers were starving and homeless. Hawtrey's point, and which was understood by Shackle, discovered also by Shackle, Hicks, and Kalecki, was that actually the long-term rate of interest, the yield on those consols bonds, was remarkably stable. It doesn't move very much through the business cycle. Hicks eventually put forward an explanation for this in his pure expectations theory of the long-term rate of interest, that the long-term rate is the expected average of the short-term rate over the period to the maturity of the long-term obligation. Why? Because if you look at a short-term borrowing is not a perfect substitute for long-term borrowing. A one-year loan is not a perfect substitute for a 10-year loan. Why? Because the one-year loan has to be, at the end of the first year, it has to be renewed. It has to be rolled over, borrowed again at whatever is then the current rate of interest, and so on over 10 years. And Hicks argued that the arbitrage between those two kinds of borrowing would mean that the long-term rate would converge on the expected average of short-term rate. And since it was an average, it really would fluctuate very much. So this was his explanation of why this long-term rate wasn't so it didn't move very much. Kalecki said that, however, argued that there was in fact one difference, and that is that if you lend money for a long term, for a 10-year period, you have the possibility of risk. So you have to add a margin for risk. Nevertheless, you have a problem that the long-term rate is more stable, and it really undermines Keynes's idea that the long-term rate determines the level of investment. And to some extent, this is why Keynes then has to introduce this concept of uncertainty to explain why the long-term rate doesn't, even if it's more stable, doesn't give you a stable rate of investment over a longer period. So you then have this. This is the beginning of this narrative of instability in expectations. And I'm always amused when I hear discussions about how investment is held back because of uncertainty. That we have, for example, with the political changes in the United States, we have more uncertainty than ever before, and to which I am always inclined to ask, how do you know it's more? Have you measured it? How would you measure uncertainty? So it's difficult. Kalecki actually took the conclusion from this much more forcefully, and said in 1954 he gave his opinion on this Keynesian view. Some authors have attributed to the rate of interest an important role among the forces underlying economic fluctuations. The long-term rate that is relevant to the determination of investment does not show marked cyclical fluctuations, so it cannot be considered an important element in the mechanism of the business cycle. Okay, so this puts aside the long-term rate of interest. already put aside the short-term rate of interest. Kalecki also had some ideas on monetary control. This was something that he was especially concerned about, or the monetary economists were especially concerned during the Second World War, because during the Second World War there was over full employment. There was potential for huge inflation, and a great potential given the levels of government expenditure, given the size of the fiscal deficit, the possibility of a loss of control over the money markets and the financial system. Kalecki in 1942 recommended Operation Twist, what's nowadays called Operation Twist among central bankers, to control the long-term rate of interest on government bonds. This is a kind of monetary operation which the US government had done in 1935, or the Federal Reserve had done in 1935, and was subsequently used in wartime and after the war, most recently used by the US government during the COVID period. How does this work? What's the function of it? The purpose of this is to control the long-term rate of interest on government bonds. If the government the preferred way of financing the government is always long-term, and if you issue too many long-term bonds, then it becomes difficult to control the long-term rate of interest. The long-term bond prices fall and the yields rise. So if the long-term rate starts to rise, the idea behind Operation Twist is that the central bank issues, or the government issues short-term bills at the central bank's policy rate of interest, or just slightly above that policy rate of interest, and uses the money from the bill issue to buy in long-term bonds until the prices of long-term bonds have risen and the long-term rates of interest falls. Interestingly, Kalecki had none of these economists who were discussing this had any were willing to tolerate any of this stuff that you find in modern monetary theory, that you simply monetize the deficit. No, you don't monetize the deficit. You use the money that's already there in the money markets, or you use the money that will come into the money markets if you start issuing bills. The whole process is helped by the fact that long-term bonds are usually held by insurance companies and pension funds, and their holdings of these bonds is inelastic. In other words, their holdings of these bonds are determined by their liabilities, by the liabilities of pension funds and insurance companies, and therefore, if the price of these bonds, if the central bank or the government starts buying in long-term bonds, more of these bond supply will not increase. Existing holders will not sell much more of these bonds, so the price will rise fairly quickly. And when the long-term rate reaches the target rate, new bonds can be issued, and the money from that can be used to pay off the short-term bills. It's a rather neat way of controlling the long-term rate of interest. It certainly allowed the US and the UK governments to keep interest rates stable despite massive borrowing during the war. Okay, let me come to my conclusion. First of all, the general conclusion that you find, I think, both in Keynes, but certainly in Kalecki later on. In Keynes, this is less so. Why? Because in Keynes's early lifetime, in the century before the outbreak of the First World War, prices in the United Kingdom hardly rose. There wasn't inflation, and during the interwar period, the problem was deflation. So there's not much in Keynes about inflation. Keynes, Kalecki, who wrote after the war, wrote much more about inflation, and saw it as being endogenous to the business side. He also saw interest rates as being endogenous to the business cycle, and that's why they're pro-cyclical and not counter-cyclical as is required by inflation targeting theory. The lags if there are lags between changes in interest rates and changes in inflation, it's possible that these are due to the lagged effect on investment of investment decisions. Let's say possibly investment decisions may be affected by the short-term rate of interest, but that's not going to be a systematic effect, because it won't affect current investment, but maybe at some point in the future. The relevant long-term interest rates really do not fluctuate too much. The impacts on financial structures, the significance of interest rate policy is really on financial structures, on debt structures in the economy, rather than the real economy or inflation. In particular, at the short end of the maturity spectrum. In other words, the difference between deposits in payments account, which is M1, the monetary aggregate that's commonly known, let's say in the United States and in the UK as M1, and deposits in all bank accounts, which would be M3 or M4. Active monetary policy has little impact on the relevant long-term rate of interest, which tends to be much more stable. Even today, it's much more stable. If you look at the most recent studies of the impact of the rate of interest on investment, for example, by Roma, they show that there's not much impact. And in other words, investment and inflation are caused by other factors. And I would say, in particular in developing countries and emerging markets, monetary policy does not really control the exchange rate. Monetary policy in the sense of sterilization of monetary aggregates or rates of interest doesn't really control the exchange rate. which is, I would say, is probably the monetary variable that causes inflation, that's associated with inflation in the developing country. So where are we left with? We're left with a kind of ineffective monetary policy which follows the business cycle. And I would end with the quotation that ends my book on Kalecki's monetary theory, interest on capital. A quotation from really a third-rate novel. Gino Bonfiglioli was an Italian who lived in England, lived in Oxford. He wrote this novel about the main character is a rather manipulative person who, at the end of the novel, becomes totally disillusioned with his manipulations and suddenly realizes that whereas he thought that he was manipulating all these events, because those events that were in fact manipulated. And I believe that this is the same with much monetary policy today. So, thank you very much for your
Esa es una buena discusión con el Banco de México. Quiero bueno, aviso que tenemos otra sala ya arriba, que habían muchas personas todavía esperando, les pedimos una disculpa, no nos pudimos mover de abajo. Antes de darle la palabra al doctor Valencia, quisiera agradecerle, él fue el que tradujo la presentación del doctor Toporowski y sin más le damos la palabra a él para que haga los comentarios pertinentes. Roberto Valencia will do now the comments, and we want to thank him for the translation that he made of your PowerPoint.
Okay, thank you, Professor Levy, and thank you, Professor Toporowski, for your exposition. It was very interesting, and thank you to Gandhi who he did the translate. Thank you. Okay. So let me begin with the comments to the second lecture, the Keynes Kalecki critique of inflation targeting. I will base my comments on the chapter 2 and 12 of the Interest and Capital book of Professor Toporowski. And in some cases, you will see a number between parentheses. It means the number page of the book, in which I support for the idea. In the next slide, let me begin. In 1930s, there was a debate about the connection between interest rate and credit as a terminal of the cycle. And in this story, Mixel is an important actor because, as we studied yesterday, he was the creator of the concept natural interest rate. And that concept was very important in the past, but maybe it's more important today, because it is the heart of the inflation targeting theory. Actually, to the defenders of that theory, if central bank is able to achieve that natural rate, it is able to achieve an inflation target. And Keynes believed in that concept. We can find evidence in the general theory, in particular in that source. Let me read. In my treatise on money, I want to say, which I call the natural interest rate, which was that keep the equality between save and investment. Let's continue and say, for each interest rate, there is a level of occupation, and for that rate, it's natural. That is natural in the sense that the system is in balance, because with that rate and that level of occupation, then it was a mistake to talk about a natural interest rate. Keynes broke with that idea in general theory, as Professor Tuporowski said, but it was an important concept in that time. Actually, it's important go to that time because because they were living the effects of 1999 crisis, and part of the debate was about what was better policy for help with the problems in fiscal or monetary policy. And in that context, a Congress was hosted in Chicago University, and with important economists as Keynes, as Simons, Douglas, and another more for Chicago School. And in particular, it's interesting the result of that event, because we can see that Keynes at that time supported the monetary policy as the principal tool for help with the crisis, but most of economists of Chicago School supported the fiscal policy. It is closely, but it is documented in Tablas 2023 and other points. And what did Kalecki say about it? As Professor said in his book, Kalecki was influenced for that ideas, and he wrote in 1949 with the connection between interest rate and investment. And particularly in Kalecki, the transfer effect was from short-run interest rate to long run, and finally to investment. But with that, the most important is the long run. But the change in short run are transferred in a lower size to long run. So the long run is more stable, and so the final impact on investment is complicated. Actually, if we try to use that framework for Mexico, now the Mexican Central Bank, the interest rate of the Mexican Central Bank, it's around 9.5%. So change the interest rate, I know, maybe 10% or more, it's very complicated. In practice, maybe it is impossible. So it's complicated thing and try to move investment through interest rate. And Kalecki said that more important than interest rate is the profit rate. And that ideas were documented in Mexico by Julio Lopez. Julio Lopez, in different moments of the Mexican economic history, write about this connection. And in recent times, there is an interesting book of Ortiz Velázquez, who did a series of interviews to entrepreneurs, and he asked them if they consider interest rate for their decision on investment. And they asked, no, we don't consider that. In the next slide, so we have problems here in one part with the change in interest rate and the final variable, because the change in interest rate and the final variable, that maybe it is product, it is level of employment, or it is inflation rate, they are not connected in a direct form. Between them, we have a box, a black box, and that black box contains a series of variables that add between them. But actually, if we check Brian, Copper, and Mann, 1923, that according to Tracy Mott, it was the laboratory in which for Taylor Hall, they said, we are not interested in studying that black box because we want to study the principal variable, interest rate, and the final variable. So they are assuming that the black box is going to work as they wish, but some cases, in most cases, it doesn't work. And another important problem is the transmission process that can take a long time. And in that time may happen many things. Actually, in the graph, you can see the inflation rate after pandemic, and the movements of interest rate. The blue line is inflation rate, and the orange is the Mexican interest rate. And the inflation rate went back to its target 1 or 2 months ago. So we are talking about that since interest rate increased, and when inflation rate went back to its target, they were more than 2 years. And in that 2 years happened much things. Actually, the Mexican government implement a series of policies with the idea to help with inflation. And in that time, China opened its growth, and that situation reduced the transportation costs. The economic impact of Russia-Ukraine war diminished at that time. And most other things. So how can we say that the change in interest rate is that why inflation rate went back to its targets? It's very complicated. In the next slide, we have problems with that black box, and in a Kaleckian framework, we can explain it because according to Kalecki, companies, we can do two groups of companies, small companies and big companies. Usually small companies want to credit, but usually banks, those want to give credit them, because for them, small companies are risky than big companies. And big companies, usually, they don't want to credit, but banks want to give credit them. So we have a problems with the behavior here, and it is a problem that, according to the professor, is that it is not a macroeconomic problem. It is a microeconomic problem, but in particular, a corporative finance problem. And actually, in Valencia 2024, in this book, we try to document the problem with the black box, and we have a series of graphs with the data to support that is the situation. Here we have the interest rate. In the bottom, you can see the interest rate of the central bank. In the middle, it is the interest rate for big companies, and at the end, we have the interest rate for small and medium companies, because in Mexico we can do three groups. Actually, I think in general in the world we can do this. We have microeconomic companies, small and medium, and big companies. And you can see that the monetary policy is very similar to that cost that big companies pay. And we have a great spread with the other one. But if we check the next graph for the micro companies, we have an important problem. The first point is the rate that we are talking about now, around 50%. And the bottom line is the central bank interest rate, and at the top it is the cost for micro companies. And they are not similar. So the monetary policy maybe is not the principal determinant for the financial cost. So the financial cost that micro companies pay is determined for other reasons, not for monetary policy. And in the next one, here's another important data. It's the credit used for investment and balance sheet restructuring, in particular in 2020. Because in that time, the interest rate was very, very small, with the idea to increase investment. But in the black bar, we have the investment. In the gray, we have the balance sheet restructure. And you can see that in most of the cases, the investment, or not investment, the companies use credit for change balance sheet. So if the impact on investment was it doesn't happen. So actually we have here that idea of Kalecki. The interest rate is not important. It's more important the profit rate, because in that time the profit rate was very low. And finally, in the conclusion, maybe in the new consensus on macroeconomic, maybe they did a series of theoretical mistakes. And one of them is that they give a series of properties to interest rate that it doesn't have a principle for the black box. And I think another important point is that they assume that agents will behave as they wish. But as we have seen in different moments, and as Professor Topolowski have tell us, it usually doesn't happen.
Thank you very much, Roberto. Creo que estamos ante un momento importante. La política monetaria no está sirviendo. Sabemos que lo fundamental es el manejo a través de las hojas de balance. Es decir, la política monetaria sí está sirviendo, pero no para lo que dice. Esa es una parte importante. Porque no vayamos a salir diciendo es que a la goma la política monetaria. Entonces, esto nos hace pensar en que tenemos que ver la parte macro, pero no tenemos que olvidarnos de los mecanismos de transmisión. Mirar las hojas de balance. Una de las cosas que nos hemos peleado siempre con los estudiantes, ay, ching, estar viendo esa hoja grande, ya, estar aprendiéndonos las definiciones cuesta, pero es la única forma, como nos ha dicho Sortobrowski y el profesor Valencia, que podemos entender qué está pasando y de alguna manera empezar a proponer problemas, ¿ya? Y discutir. Yo creo que en el Banco Central se lo saben mejor que nosotros, pero no lo pueden decir por un problema ideológico. ¿Ya? Entonces, en ese sentido, ustedes tienen la palabra ahora, porque espero que nos sigan. Nosotros ya dentro de poco diremos adiós. Eh, pero espero que dejemos gente pensando. Preguntas. Por favor, Manuel. ¿Nos ayudas? Perdón, pensé que te iban a dar el... ¿Me ayuda, por favor? Sí, es que sí estaba...
Okay. Well, thank you very much both. It was a very nice presentation, very complimentary one to the other. Professor Toporowski, I have a question. I was reading the first part of the collected works on the business cycle theory. A question came to my mind now that you mention it. Kalecki presents a order and delivery theory of investment, which depends on machinery. Do you think that assumption still holds in the sense that we have, I know the idea is more like present how as investment this determine present investment decisions. However, I don't know if the mechanism that Kalecki presents there on the time that it takes to actually produce the machinery and get still holds. I had that question in mind. And second clarification, I didn't get quite well what was the stance, if there was like a definite answer from Kalecki to the long-term, the determination of the long-term interest rate. If there was like a settled theory that we can take as defined by Kalecki, I mean, he changed a lot. He quite modified many times his investment theory. So I don't know if the same happened with the long-term interest theories. Yeah, those were my questions.
¿Hay alguien más que quiera hacer una pregunta, por favor? Compañero de Yacha, ¿te puedes presentar?
My question is for Professor Toporowski. At the conclusion of your presentation, you said that for development countries, the exchange rate, not the interest rate, it doesn't have any affection of the exchange rate. Yes, and we have a question. We didn't understand why. So that's our question.
¿Hay alguien más que quiere preguntar? Alberto Llama. Se lo das al compañero. Ah, ¿había otra persona, perdón? Adelante, por favor.
Yes, thank you very much. To you for the presentation, very interesting. But I'd like to say something about the discussion. And just to say that many countries are rethinking the inflation budgeting principle. Singapore, Chile, for instance, and many other countries are finding beneficial to manage the rate of exchange. See? So one key element of commodity policy.
Acórtala porque hay varios más.
Yes.
Termina.
No, I mentioned my points.
¿Hay algo más? Adalberto. Sí.
So, first of all, thank you very much, both. Professor Borowski, Roberto, thank you very much. One of my questions here, and I think this one could be delivered for both of you, is if we try to analyze the changes of the monetary transmission mechanism through the balance sheets, we might say big enterprises balance sheets, how can we say then in a developing economy or emerging market, might say like Mexico, how linked are the balance sheets of the big enterprises in Mexico with the international financial market? Because as far as I've been understanding, between yesterday and today, there's a sort of a monetary cycle internationally, a monetary cycle which could influence in the big corp's balance sheets here in Mexico, and how that could modify some behaviors in the Mexican economy, such as investment, consumption, etc. That's it. Thank you.
We have a question, a very long question.
No, son tres preguntas.
Del mismo.
Sí, del mismo.
Well, three questions, three issues, by one, ¿sabe quién?
Es Eric
Eric,
Sokoyotzin.
no sé si por ahí, por usted, no. It's a few questions. One is in an economic system where investment is primarily driven by effective demand rather than interest rate, and consider the inelastic demand for government bond companies and pension funds, both can an operation twist policy genuinely alter the incentive for capital accumulation. Seguimos. Operation twist are not for that. Seguimos. Furthermore, firms liquidity preference and given the reduction in long-term interest rate could differently impact industrial and capitalists, and how would this mechanism interact with the oligopolistic markup structured in non-perfectly competitive markets? I think we leave it here, or you on here. There you are. Furthermore, if firms liquidity preference, no, it's a red. ¿Dónde íbamos?
Sí, se hace más grande, sí.
Okay. I see, given a context in which innovation is primarily driven by effective demand rather than cost of finance, how would a reduction long-term interest rate affect the intersectorial distribution of economic surplus between financial capital and industrial capital? Thank you. Querían hacer la pregunta Okay, so we give the microphone now to Professor Brodsky for him to answer the questions and perhaps the comments of Dr. Kalecki.
Okay, let me start off with the from the end backwards. Okay. Long-term rate of interest affecting distribution between rentiers and entrepreneurs yes, this does affect the distribution between rentiers and entrepreneurs. But I think it affects it in complex ways. It doesn't just alter it. It's not just changes in the long-term rate of interest that, in other words, where the long-term rate of interest goes up or down, that affects that distribution, because that distribution, as I said, the long-term rate of interest doesn't actually change very much, so it wouldn't, affect distribution very much. What does affect that distribution might be portfolio factors and the type of long-term securities that are held by rentiers, whether they're stocks or shares or bonds. But there's another factor that enters into it, and that is the very fact that corporate restructuring is really what happens in financial markets all the time, and this really does play havoc with the figures on distribution between so-called rentiers and entrepreneurs, so that it's not easy in practice to distinguish them. In this respect, it hasn't changed from Marx's time. Marx noted this as well. The internal financing margins. Yes, there are internal financing margins. These are important, but not necessarily as important as is sometimes made out. For example, in recent years, certainly since the 2008 crisis, because of quantitative easing and so on, the internal financing of corporations, internal funds of corporations has been very, very high, and it hasn't really impacted on investment. It did impact on investment in just corporations becoming more and more liquid. Can Operation Twist alter the incentives for capital accumulation? No, I don't think that's the purpose of Operation Twist. The purpose of Operation Twist is actually to control, is as a form of financial control, to control long-term interest rates, so that they stay on target. So it's a little bit like yield curve control. It doesn't. I doubt that it has much impact on capital accumulation. It has a huge impact on financial structures, because you found, for example, when the Japanese central bank pushed medium-term interest rates down to near zero, and it's just simply accelerated Japanese insurance companies and pension funds buying of foreign assets, and similarly Japanese companies buying foreign assets. So that's really the purpose. So it's a form of financial control. The link between the international financial market and other national financial markets and the international markets. Really, this is something, this concerns what I've elsewhere called the international monetary business cycle, this tendency for there to be an international monetary business cycle for central banks to follow on following their monetary policy, the monetary policy of the US central bank. The switch from inflation targeting to exchange rate targeting that was mentioned, that is actually a very good, it's a very interesting new development. I think that there will be more of this, in particular as the American central bank, the Federal Reserve, moves periodically in crisis. It moves to reinforce its central position in the international monetary system by through swap facilities with our central banks. Because essentially what those swap facilities are doing, and I must say this is I haven't yet thought through my final analysis of this, but what it certainly appears to have done is stabilize exchange rates. And once exchange rates are sufficiently stabilized, there will be a queue of central banks stepping forward to say, yes, we're switching now to exchange rate targeting, and in parentheses, in brackets, this will be easy to do because they're stable. That's it's an easy target for central banks. Why does the interest rate just not affect the exchange rate? Well, because I think of institutional factors such as this, such as the emergence of an international money market based on dollar swaps. The determination, what determines the long-term rate of interest? Well, this is essentially supply and demand in the bond market, in the secondary market, as Keynes correctly identified. And I think it tends to be regulated by the central bank because the central bank has an interest in regulating the liquidity of that market for the purposes of government borrowing. Order and delivery mechanism in investment. Yes, this is true, but we also have to bear in mind something else, which I think I'm very pleased that Professor Valencia put forward, and that is the fact that the ability of companies to obtain external funds is really determined by their existing indebtedness. This is Kalecki's principle of increasing risk. It's something I should have perhaps paid more attention to in my lecture. I'm very delighted that Professor Valencia mentioned it, because it is a factor, and it means that the level of indebtedness is maybe a more factor in the ability to invest than the actual rate of interest.
I don't know if it's reiterative, but I think an important point is in the Kaleckian framework, the internal saving, because it is the support that the companies has to negotiate with banks the financial cost, because the small business, they don't have a big internal saving, and the big companies, they have that ability. And of course, they have the support of the international groups that let them to go to negotiate that cost. And they have access to a different markets with different financial costs. That is a big difference with the rest of the companies.
Well, I will say last thing. I think the big difference between Keynes and Kalecki, it's really that one uses the interest rates and Kalecki uses financial risk. So in financial risk, you have interest rate movement, but it's not only, I think was the last question, which determines how much liquidity a firm can access. And again, remember our friend Tracy Moore, the problem is the difference of access of liquidity and the cost of liquidity between a big and bad. Bueno, aquí ya tienen una historia que podemos seguir discutiendo. Tenemos las grabaciones y se pueden seguir discutiendo y profundizando incluso para la investigación. Quiero terminar agradeciendo al público. Tuvimos 2 salas llenas. No sé qué aforo tuvimos en Zoom. Eso ya no pudimos ver. Pero nos enorgullece estar en una universidad donde podamos discutir ambos puntos de vista y no nos tengamos que contribuir a la ideología dominante. Eso da gusto, eso adelanta el pensamiento económico y permite hacer mejores políticas económicas. Enhorabuena para todos. Gracias.
¿Hace cuánto iba?
Lo cerramos.